All a CFD does is replicate a transaction in an underlying asset, let's say a stock, for example. But we don't need to borrow the asset, okay? We just go through the process of the transaction. Now, CFDs have gotten a little bit of a bad rap from time to time in the past, but generally because some investors have lost money using them. And the potential problem here is that you can lose more than your deposit on a CFD trade. So let's say you put a deposit down of $500 to do a trade. If you don't manage your risk correctly, with discipline, with stop losses, you could lose more than that $500. Now, Think Markets, we have a system called negative balance protection to protect our clients from that ever happening, but it might not be the case with your other CFD brokers. Look, the message I have for you here is this tradesman using that circular saw. He's got all the protective equipment on. He's had all the training in using that circular saw. And what that circular saw does for him is it does the job faster, it does the job quicker and cleaner than if he was using the old-fashioned handsaw. Now, should that circular saw, should there be a mishap, lapse in concentration, and he knocks a couple of fingers off, I don't think you can blame the circular saw, okay? It's not the circular saw's fault. It is always the person using the tool's fault. CFDs are just a tool, ladies and gentlemen. Don't blame the CFD. On to our third step of protecting your portfolio in a bear market, and that is to hedge your portfolio, potentially again with CFDs. And what we're going to do here is take a short trade on the stocks in our portfolio. A lot of people come to me and say, hey, Carl, look, I do think the market's going down. I get it, but I don't want to sell my shares. I can see the portfolio management tool's gone all red, but I don't want to sell my shares. Capital gains tax is a problem, or I would feel naked without my shares. I get it. Okay, what can we do in that scenario? Well, this concept of hedging simply means having a bet each way. So your main bet is your portfolio. You want that to go up. What we're going to do here is take an equal and opposite position on our portfolio, and each stock in our portfolio using CFD. So for example, if we had the 50 Tesla shares, we would be looking to short 50 Tesla CFDs. If we had 1,000 BHP shares, we'd be looking to short 1,000 BHP CFDs. And if you can create that equal and opposite position on your portfolio compared to the CFD shorts, you have effectively eliminated your downside risk. It really doesn't matter how much your portfolio goes down now, your stock-based portfolio, the profits on the shorts in your CFDs will compensate you for those losses. Now, this is really exciting because if you can use, again, the traffic light system to tell you when to close out those shorts, the profit you take on those shorts can be reinvested back into the stocks in your portfolio or to add new stocks in your portfolio. And you think about when the profits on the shorts come. They come when prices have fallen a long way. So the cash you have here to reinvest is generally done at some pretty good prices in the market. Now think about how that compares to your average buy, hold and hope strategy where people are just holding their portfolios all the way down and then waiting for them to go up again. You're really being proactive here. Now, the asterisk is important. The asterisk says, yes, you've eliminated your downside risk, but at the same time, there's no free lunches. You've eliminated your upside risk as well. So if your portfolio increases in value, it's not a bear market anymore, it turns into a bull market, you won't get any profits on that portfolio until you close out your hedge. But again, we need to have a strategy for understanding when and how to do that. But think of it in these terms. You are potentially giving up some reward, and let's say it's 5% or 10% until we back out of those hedges to get complete downside protection. So maybe you're giving up 5 or 10% to get 100% protection. I think from a risk return perspective, I think that's a really, really sensible and valid way of looking at things.